All right. Well, hello, everyone, and welcome to MSU Federal Credit Union's Financial Education Seminar Series. We appreciate y'all joining us, and we're excited to have you here with us virtually this afternoon. Now, these presentations were created with you in mind with the intention to give financial education on a number of relatable topics to help expand your knowledge of finances. Each event will be hosted by a member of our financial education department or one of our partners, connecting you with resources in our community. We have a number of diverse presentations planned for you this year, and you can explore and register for this year's events by visiting us at msufcu.org/events. Today's webinar is being recorded. Now you can rewatch or share the presentation by going to youtube.com/MSUFCU. Then select MSUFCU Seminar Series from the playlist options. Recordings are available within 2 weeks of the events. We will have time after today's presentation to address questions submitted to the Q&A, and this segment will not be recorded. You may send your inquiries at any time during the event, which will later be answered in the order that they were received. I, Lindsay Morgan, will be your facilitator this afternoon, and today we have an amazing guest joining us to tell us how we can maximize our tax savings in retirement. So allow me to introduce our host, Rianne Horgan, the CEO of Silvur. Rianne worked for 17 years at JP Morgan, where she advised individuals and families on investments, credit, and wealth planning. Recognizing there was a need for further education, she then founded Silvur to provide members like you with retirement calculators, tools, and education through their platform, Retirement Simplified. We're excited to have her here with us today to help you learn about the tax updates and tips that will help you optimize your 2023 tax return. Rianne, I'll gladly go ahead and turn things over to you so you can start us on our educational journey this afternoon.
All right. Well, thank you, Lindsay, for that warm welcome. We are thrilled to partner with MSUFCU. Silvur is a free member benefit for all members over the age of 50. And so I'm super excited to be able to bring a lot of the education that we have in that digital platform to you here on the webinar today. So as Lindsay mentioned, today I'm going to focus in on some, in particular, year-end tax tips. So I'll do some previews for 2024 also, because I know we're kind of in that end of 2023, beginning of 2024 planning for many folks. Our goal today is really just to help you keep on top of, frankly, what are some of the key important numbers that come out from Social Security, Medicare, IRS at year end that really impact your taxes. I know that it's quite frustrating for many members. The numbers seem to change every year, but the reality is they do. And so our goal at Silvur is to really make these numbers accessible to you so that you as you're working hard, make sure that you're able to take advantage of as many of these tax saving strategies as possible. I would just kind of flag that we are not a tax advisor. And so, we will, answer as many questions as we can at the end. But, typically what we find is there's some very personal fact patterns that are a little bit hard for us to answer live, but we will do our very best job. And then, when there are specific facts and circumstances, would definitely encourage you when it comes to tax specific questions to talk to your accountant. So let me just maybe give a little bit of background on Silvur and Retirement Simplified, what we do. At the heart of what we do at Retirement Simplified is really help you pull all the different pieces of your retirement together to answer what we know is that many members question, which is, do I have enough money saved for retirement? We answer that question through a retirement score that helps you predict how long your savings are going to last, and then helps you make changes to your plan that may make your money last longer. So helps you understand if you work a little bit longer, or if you add part-time income, or if you move, how might that change your retirement score. Our goal is to make it really easy for you to understand platforms like Social Security, Medicare, understand how spending and where you live in retirement impacts that score. In addition to tools and calculators, we have a lot of education, and these are short 3 to 5 minute lessons on, all the big topics that many of you are rolling up your sleeves and learning about right now: Medicare, Social Security, taxes and retirement, cost of living, inflation. Our goal is to have this be a place you can keep coming back to over and over again, because we know that learning about all these key topics takes time. And so, you can really think about this as like a library of content that's personalized for you based on who you are. So you tell us a little bit about yourself, and we'll make sure to get you the education that we think is most relevant for you. We make a huge effort to keep this up to date. So right now we're taking all the data that came from Social Security and Medicare and IRS for their year end, and we're going to be updating everything as we go into the new year. So you'll see 2024 data as you enter into the experience. And so again, our goal is make it easy for you to consume, but also keep it up to date so you know that you're looking at accurate information as you're making important decisions for yourself. One thing I would just flag is that this presentation today has a lot of numbers, and I try not to have too many presentations with lots of numbers, but it's hard to talk about taxes without talking about numbers. And so what I wanted just to say as we start is, please don't feel like you've got to scribble down all the numbers. Not only do we have this replay that's going to be available, but if you log on to msufcu.silvur.com, create your profile in Retirement Simplified, the class with all the numbers is there. And so we'll make this really easy for you to get. And so hopefully you can just listen and learn today and take confidence in the fact that all the data is actually in Retirement Simplified, and will be really easy for you to access after the fact. So with that, I'm going to cover a couple of kind of big topics. We're going to talk about in particular things that you should be doing, as we go into this last couple weeks of the year, as you think about really optimizing your 2023 tax return. I'll also give you a sneak preview of what's happening in 2024, because we're kind of, again, at that time of year where you may be thinking about, oh, I've already taken care of everything for 2023, and you might be more curious about what 2024 what lies ahead. We're going to talk about contributions for accounts like 401ks, 403bs. We're going to talk about required minimum distributions. We're going to talk about when Roth conversions may or may not make sense. We'll talk about tax loss harvesting, gifts and charitable donations, and then a kind of a year-end healthcare checklist. All of this is going to be done within the context of someone who's getting close to retirement, or actually is in the early days of retirement. So this conversation today is not for 20-year-olds. It's really for those of you that are in your 50s, 60s, and 70s, and hopefully that'll be apparent as we go through this. So let's talk about kind of what's big new for 2023 tax return. And I would also say what will also be relevant for your 2024 tax return is that every year the IRS makes annual updates to tax brackets, 401k contribution limits, HSA limits. And that's because while the IRS is not allowed to change tax rates without congressional approval, they are allowed to make what are called inflation adjustments to all of their numbers. And a lot of what we'll talk about in the beginning here will basically be the inflation adjustments that have been made that impact how much you can put in retirement savings accounts, that impact the dollar amounts you can earn within different tax brackets. So let's start with in many ways, this is one of the few ways I would say is how do you make inflation work for you? We all know that inflation has been bad for most of our pocketbooks. But the reality is there are a couple of places where I would say two places the government tries to give back and one place where they probably take it away. On the Social Security side, for those of you that have enrolled, you will know that Social Security has an annual cost of living adjustment. The cost of living adjustment for this upcoming year is 3.2%. You will be receiving notification in the mail this month, which describes what your new benefit amount will be. And starting in January, you will start receiving that new benefit. Hopefully that is being direct deposited into your account at MSUFCU. That number is lower than it was on the prior year. The prior year's adjustment was 8.7%. That was a huge number. It was obviously a time when inflation was running really rampant, but it was the highest cost of living adjustment that we've seen in 40 years. So the one thing I would just say is that for folks that haven't elected Social Security yet, I want to just make sure that you know that those inflation adjustments also roll into your benefits. So your benefits are being adjusted even if you're not receiving Social Security yet. Keep in mind that the COLA adjustment is always a positive number. So at the worst case scenario, it's a 0. And then the number can only be positive from there. So this year, the average Medicare recipient the average Social Security recipient is receiving a 3.2% increase. The reality is the government takes some of that back when it comes to Medicare. And so when you look at the premiums this year for Medicare Part B and deductibles, those have all risen. And so for many members, you're seeing actually very little net benefit in your kind of, let's call it after Medicare take home paycheck, because you are seeing kind of an increase in the Medicare costs. For those of you that are receiving Social Security today, you know that your Part A and Part B premiums are automatically deducted, and Social Security sends you the net payment. Those new Medicare premiums will also be on the statement that you're receiving from Social Security this month. Again, in January, those new numbers will actually hit your bank accounts. And then finally, IRS. So the IRS comes in, and I would say generally what the IRS is doing is they're rolling through these inflation adjustments. So they're increasing the amount of money you can earn in every tax bracket. They're increasing kind of credits and deductions, and we're gonna talk a little bit more about that. As we go through, what I would encourage you to do is just add questions to the Q&A. We're going to hold questions until the end, but please throw them in, and we'll make sure that we answer them. So if there's something that's coming up, feel free to drop it in, and we'll make sure to address it at the end. All right, on the tax bracket changes. So the first thing just to know is that, again, I mentioned that the tax brackets increase due to inflation every year. The tax rates have not changed. And so I just picked the rates for the 22% rate. And what you'll see is that between 2022 and 2023, there was about a $3,000 increase in the tax bracket for single individuals, and about a $6,000 increase for married individuals. There was another increase for both single and married folks that was rolled through in the 2024 announcements that you can find in our 2023 annual updates class. So all that data is included. But again, the point to keep in mind here is that the rates are not changing. It's just you are able to earn more money within a specific tax bracket because the government is kind of adjusting upwards these tax brackets. Second thing to be aware of is that every year the IRS does make these inflation adjustments to 401k and 403b contributions. So between 2022 and 2023, we saw the contribution limits rise by about $2,000 for your 401k or 403b contribution. That number has increased a little bit more this year. So for 2024, the contribution amount is actually $23,000. For the 2023 tax return and for the kind of the calendar year, you were able to, from a catch-up contribution perspective, contribute $7,500 to a 401k or 403b. The catch-up contribution for next year for 2024 did not increase. It was held stable at $7,500. So just keep in mind the catch-up contribution is open for members that are over the age of 50. And this is, I would say, just one tax benefit the government gives as you get closer to retirement to give you the ability to put more money away in a tax-deferred savings account. So again, these numbers will change every year. They go up, they increase with inflation. And so, if you're in a position that you are able to max out your 401ks, would just flag that you have until the end of the year to do this, and we'll go through some deadlines also. But just as a reminder, you've got a couple more weeks, maybe only one more paycheck deduction, and so it might be worth, as a follow-up from this session, is just to go check your last pay stub, see where you are from a contribution perspective, and just to know that if there may be a last minute one last opportunity to kind of max out that account. So the IRS also makes updates every year to the IRA contribution. So between 2022 and 2023, the IRA contribution limits increased to $6,500 and then also they give an IRA catch-up contribution. And so there's a much smaller amount than what you see on the 401ks and 403bs, but you can put an additional $1,000 into an IRA catch-up contribution if you're over the age of 50. So again, just keep an eye on these numbers. This is where I would say with the IRAs, you have a little bit more time, and we'll go through the dates, but you actually can fund the IRA all the way up until tax time. And so we'll go through those dates at the end. One thing just to remember is that, when the Secure Act came out in, I guess it was 2021 or 2022, it enabled you to still make contributions to your traditional and Roth IRA accounts, even if you're retired. And so just keeping in mind, as you just think about your specific situation, there may be opportunities, even if you're retired, to keep making contributions. All right, so many of you on this phone, I'm going to imagine, have 401ks, 403bs, and one of the benefits from those accounts is that you are able to put money in those accounts pre-tax from payroll. And then what is that in retirement, when you take savings out of those retirement accounts, that they're taxed at income tax rates. The government does not want this to be a forever kind of tax haven. And so what the government says is that once you turn a certain age, now it's 73 years old, you have to start taking money out of the account. And this is the government's way of saying, look, we've given you a benefit, like a tax deferred savings account for a long period of time, but at some point the expectation is you start taking money out, we receive our taxes, and that's kind of how they fund part of the program. What I would just kind of make sure that everyone knows is that if you have an IRA, 401k, a 403b that's starting at age 73, you're going to take money out of those accounts. If you already are taking RMDs right now, what I would just remind you is that the RMDs you need to take out by the end of this year are based on last year's balances. And so it always looks back to the prior year. And so hopefully you're in a position that your accounts have risen this year with the markets. And so just as you're thinking about the percent you need to take out, do reference back to your 12/31 balance as you do the calculations. The percent you need to take out every year changes based on your age. If you're married, what I would just remind you is that the amount you take out of your spouse's account or your spouse takes out of their account will be based on their age. And so you do need to run the numbers individually for your accounts. Secure Act 2.0 did delay the RMD age. It used to be age 70 and a half, and then it increased to age 73. And by 2025, the RMD age will be 75. So depending on what your age is, you may have slightly different RMD start dates, but the government has been pushing that back a little bit as a way to enable savers to hold on to their savings for a little bit longer in a tax deferred account. All right, so we get a couple of questions from folks on how to reduce required minimum distributions, and that's because many of you may find that you don't actually need to take the full amount out of your retirement savings accounts, and you feel like you're being forced to take money out of those accounts to meet those RMDs. So there's a couple things that folks often think about when they're trying to kind of manage their kind of what they would think about as like an RMD liability. The first thing to think about is that if you make charitable donations, you can make a donation directly from your IRA to a qualified charity. What I mean by directly is you cannot get the money as cash into your account at MSUFCU and then donate it. The money needs to go directly from your IRA to the qualified charity. But that donation can actually be used as part of your required minimum distributions. It will be treated as a distribution. So it's a really tax efficient way to think about both kind of meeting your charitable goals, but also kind of checking this box on this tax obligation you have. The second thing that folks sometimes think about is converting funds to a Roth IRA. I'm going to talk a little bit more about Roth conversions. But the one thing I would just flag here is that Roth IRAs are not subject to RMDs. So your 401k, your 403b, your IRA, those are all subject to required minimum distributions, but your Roth IRA is not. So park that thought because we're going to come back to it in a second. I mentioned that the deadline on withdrawals for this year is based on your 12/31/22 account balances. Why do I spend this much time talking about RMDs? Because the penalty for getting it wrong is really high. Today, the penalty is a 25% excise tax. It can be applied to either late or miscalculated RMDs. And what I would say is that number is lower than it used to be. It used to be a 50% excess tax, but the penalty for getting it wrong is really high. And so this is just an area that's a little bit frustrating to have to deal with, but I would just say that you have worked too hard for your savings to be handing a quarter of that amount over to the government. And so that is where, whether it's through Silvur or the team at MSUFCU, we can help you with those calculations too, if you need some guidance kind of navigating these calculations. Right, so I said park the thought on Roth conversions, so let's dive in and talk a little bit about them. So what is a Roth conversion? We heard in particular 2 years ago, a lot of people thinking about Roth conversions, and I'll explain why in a few minutes. But a Roth conversion, very simply, is when you take a tax deferred account. So think about that as a 401k, a 403b, a IRA, and you convert it into a Roth IRA. What that means is that you, when you do that conversion, any gains you have in the account are treated as income, and so you basically trigger the gains. You from a tax perspective have income tax, and then your savings now are in a Roth IRA. That, if you remember, the difference between a Roth and a traditional IRA is the Roth IRA, you pay taxes on upfront the money, but then it grows tax free. Whereas a traditional IRA, you don't pay taxes up front, but you pay taxes on the back end. Roth conversions are often interesting for folks that have hit the income limits for Roth to originally fund a Roth. And so, when you make that withdrawal after you've done the conversion, the good news is that the distributions are tax free, even if the account has seen significant growth. And so I think, the folks that are doing Roth conversions are really thinking about they'd rather pay the taxes now and kind of let the savings grow for a longer period of time. So when do Roth conversions make sense? A couple of things. The first is people were talking about this a lot 2 years ago because their IRA accounts had losses in them. So they were actually able to do the Roth conversion without triggering tax. So that's one thing just to always think about, is that you should just take a look at your retirement savings accounts. If any of them have like a full-on loss in them, you can actually do the conversion without triggering tax. My guess is that you may have that experience if for money that you put in the last like 5 years, but you just need to kind of take a look and see if that account has a loss. So when do Roth conversions generally make sense? They make sense, from a kind of a markets perspective. Secondly, if you're not able to directly fund a Roth IRA, and so if your income is higher than what those income limitations are, that can be an interesting time to fund a Roth. Again, I talk about the IRA has losses, so you're not triggering income tax. It may make sense to do a Roth conversion if your income today is lower than when you expect it in the future. So this is a scenario where, for example, you may have just retired, and maybe you haven't started receiving Social Security yet. And so all of a sudden you go from having an income tax bracket, which was related to your working income, to now an income tax bracket that looks very different because you don't actually have any income coming in. And so oftentimes we find folks really thinking about Roth conversions in the early years of retirement when their tax bracket has changed. They may also, though, expect that their tax bracket is going to increase in the future as they start receiving Social Security and other income. And so, again, if you have these moments in time where your tax rate actually drops for a full calendar year, that could be an interesting time to think about doing a Roth conversion. The final scenario is really thinking about estate planning. And this is where you may have a child who you want to receive, or any other beneficiary you want to receive a retirement savings account. And it may be based on their tax situation that you think could be more beneficial for them to receive a Roth rather than a traditional IRA. There used to be a major loophole where that Roth could basically be held in perpetuity. So it actually was like a really huge benefit to doing a Roth conversion. The government in the last couple of years shut down that loophole so that your beneficiaries can only hold on to the account now for about 10 years after they receive it. Still very attractive, but not the super attractive benefit that it used to be. So this is a perfect situation where like your fact pattern, your goals in life, your fact pattern, your spending, where you live is all going to influence this. And this is where, like, for example, the financial advisor team at MSUFCU can be really helpful in guiding you to think through, like, does a Roth conversion for me make sense? Because I will tell you that it is very fact specific. And I know that on this phone today, I will not be able to tell you whether it makes sense for you, but I know the team, by kind of understanding your goals and your specific fact patterns, will be able to help guide you through that decision. A couple warning points I would just say about Roth conversions, because everything I talked about sounds fairly positive. The first is that a Roth conversion generates income. And this is really important if you're age 63 and above. So at age 65, most folks know that you'll be enrolling in Medicare. The reason I say age 63 and above is that a Roth conversion that does generate income is, from a Medicare perspective, kind of captured as part of what's called the IRMA surcharge. One of the two of the parts of Medicare have like a high income earner penalty. And so for Part B of Medicare and Part D of Medicare, if your income is above a certain threshold, you actually pay an additional premium. The reason I mentioned age 63 is that Medicare looks back over 2 years to see if you basically were in this high income bracket. And if you were in that high income bracket over the prior 2 years, then you are charged this premium surcharge. So the first thing to think about is like understand that a Roth conversion, if it does generate income, that income will actually be part of the Medicare assessment of whether or not you're subject to this surcharge. Second thing is the 5-year waiting period. So once you do the conversion, you're not supposed to touch the funds for 5 years. And so that's important. You also, from a beneficiary perspective, really need to live for 5 years. It's a little complicated. If you die before 5 years from the conversion, there's some complexity around whether your beneficiary actually receives a Roth or your traditional kind of IRA. And the last point I made was about the 10-year drawdown. So we've kind of covered that already. So again, there are definitely some benefits, but I would just also say, just make sure that kind of these other fact patterns you've taken into account as you determine whether it's an appropriate decision for you. All right, I'm gonna move on to tax loss harvesting, but Lindsay, I'm realizing that we did not mention at the beginning that we've got a poll. So do we want to just pause for a second and tell members how they can do the poll with us? Does that make sense?
Yeah, absolutely. Thank you for reminding me, Marianne. So everyone, we do have a poll that you can take. So we're going to go ahead and work on sending that to you all now. And that'll just kind of help us to gauge, what is it that you're looking for as you are on your retirement journey. And then we can, if it makes sense, follow up with you, kind of explore and help guide you along that path as you are either getting started or looking for different opportunities. So you will find that there. Again, feel free to respond to that. And then we will look forward to sharing some of those anonymous results with you later on in our presentation.
All right, thanks, Lindsay, I appreciate it.
Absolutely.
All right, let me just see if I can close the poll on my screen. So, because it's taken over my screen now. So here we go. All right, so let's just talk about tax loss harvesting. So we're in December and some of you may have a few losses in your accounts and you're thinking about like, do I want to take some of these losses right now to offset some gains I may have in my account? So the concept of tax loss harvesting is basically a way to try to like offset gains that you have in your portfolio. And so it could be offsetting capital gains. It could be offsetting ordinary income, although there's a limit of up to $3,000. It also could be helping to offset taxes from a Roth conversion, for example. So a couple things to think about here. The first thing is that tax loss harvesting only is applicable to taxable accounts. So that means it's not applicable to 401ks. It's not applicable to 403bs. It's not applicable to Roth accounts. It's really applicable to what folks would have historically kind of thought about as like a brokerage account, like an account that you might have where you've got a bunch of stocks or a savings account that you have. The key thing to think about is that if you're doing tax loss harvesting, the government says, great, you can sell your shares and trigger the loss, but you can't buy it back immediately because that then just feels like you're kind of taking advantage of these tax rules. So what the government says is you can't do what's called a wash sale. You have to wait 30 days before you buy back either that stock again or something that they deem to be substantially similar. Substantially similar is like a term of art. It's kind of up to the IRS. There's definitely some kind of gray lines there. But what I would just say is that if you have shares of Coca-Cola and they are at a loss right now, if you sell those shares today to trigger the loss, you can't buy the stock back for another 30 days. The full window is 61 days because the day that you sell is kind of like the middle day. And so you have to look back 30 days before and look forward 30 days to say, look, I have this kind of like blackout window now of 61 days. We've already passed the deadline if you were thinking about selling Coca-Cola and buying it back this year. So that deadline was November 30th. But if you just want to sell Coca-Cola and trigger the loss, you just need to sell those shares by 12/31/23 in order for those losses to be recognizable in your 2023 tax return. Again, this is an area where like the team at MSUFCU can be helpful. the financial advisors there could take a look, for example, at your list of stocks, help you think through, are there any particular stocks that make sense to be selling, as well as then thinking about like, what does that portfolio look like for 2024? All right, so let's talk about gifts and charitable donations. So for 2023, so meaning this year that we're just wrapping up, you can make as an individual gifts of up to $17,000 per person. It is not a tax deduction, but it is not taxable. So when you think about like kind of tactics to lower your taxes, the fact that it's not taxable is really an attractive outcome for folks. I would flag that for 2024, that number has increased to $18,000. If you are married, you can give double the amount. And so the limit is based on who you give it to. So you can't give an individual, like if you're single, you can't give a godchild more than $17,000. You can give each godchild, if you have two godchildren, you can give them each 17, but the limit per recipient is $17,000. Again, if you're married, it can be double that amount. For 2024, again, that amount is increasing to $18,000 per person. That can be for folks that would prefer to do what's called lifetime giving, so give money away while you're living rather than giving money away after you die. The gift exemption can be a really attractive way to do that lifetime giving. Remember when you're and that's gifts to like individuals. Obviously, gifts to charities, if done in the appropriate way, are not taxable. And I think, again, the appropriate way comment is really making sure that if you're doing the donation from your IRA, that you're doing what's deemed to be a qualified charitable donation, so you can actually make it directly from that IRA account. All right, so I'm going to pivot to healthcare, which might seem a little bit odd when we're talking about taxes, but there are a couple of savings accounts that actually have some tax benefits that I want to just make sure we're all up to speed on. So the first thing are flexible spending accounts. Less of a tax play here, but I just want to flag it because FSA funds are what I would call use it or lose it. If your employer provides you with an FSA, if you don't spend it typically by the spring, and actually I think that should be, instead of March 15th, it should be April 15th. So if you don't spend your FSA by tax time, you lose those funds. You do need to triple check that your plan allows the extension into tax time. Some plans don't allow that extension past December 31st. But many plans allow you to go all the way to tax time. And so I would just say, check with your employer to see if you have, the first month of the year, for example, to, buy eyeglasses with your FSA. But most important thing is FSAs are use it or lose it. Not to be confused with an HSA, which is not use it or lose it. You can continue holding on to that account. So HSAs are probably the most underutilized retirement saving account out there, and they're one of the most valuable accounts. And that's because an HSA comes with what we would call a triple tax advantage. You can contribute money pre-tax to it. So that sounds like a 401k. You can grow your money tax-free, which again sounds like a 401k. But the extra bonus here is that during retirement, you can withdraw money tax-free. So that's like a Roth. So you basically get the tax benefit of a 401k going in and the tax benefit of a Roth on the backside. So it's really the most tax efficient account you can have. The key thing here is you need to be in a high deductible healthcare plan in order to be eligible. So there are restrictions, kind of like Roth accounts have restrictions. HSAs also have restrictions. So if you find yourself in a window, particularly, those of you that might have retired before the age of 65, you might have gotten into a high deductible healthcare plan as a bridge to Medicare. This might be a good time to think about funding an HSA. I have the numbers for 2022 and 23 here, and those numbers also have increased again for 2024. So the limit to put it as an individual into an HSA for 2023 is $3,850, and that number has actually increased to $4,150 for the 2024 tax year. All right, we're getting close to the end. So I want to give everyone a warning that now is the time if you have questions to make sure you're getting them into the Q&A. I wanted just to quickly go through a couple of dates to remember, just because I know we went through a lot. Again, reminder that after this webinar, I would encourage you to create a profile at msufcu.silvur.com. When you create your profile, you will find the class with all of this information in it. But a couple things to think about. We've passed the deadline already for tax loss harvesting for that, sell Coca-Cola and rebuy it. December 31st is for those of you that are in the RMD age, you need to make those withdrawals by then. Tax loss harvesting deadline is also December 31st if you want to sell your Coca-Cola and recognize the loss in 2023. It's also the deadline for 401k and 403b contributions. April 15th, meaning tax day, is actually the deadline for IRAs, HSAs, and most FSAs. And so just to kind of keep in mind that you have a little bit of extra wiggle room when it comes to those accounts. And so if you're trying to figure out, like, that's a lot of stuff to get done before year end, I would focus in on making sure, if you have the opportunity to max out a 401k or 403b, that you get that done before year end. And then you can, look at your IRA and HSA in the new year. All right, so if I maybe just shift a little bit to think like forward, a couple of things that I would really encourage everyone to take a look at. Whether you're receiving Social Security or not, I would encourage you to review your Social Security benefits. As I mentioned, there was a 3.2% cost of living adjustment this year. We have several Social Security calculators in our Retirement Simplified experience. And so one of the things that we can do for you is we can estimate your benefit. You should also log on to the Social Security website and see your benefit there. The difference between what Social Security does and what we do is that Social Security does not factor in spousal benefits, does not factor in divorce benefits. And so if you're married or divorced or widowed, like those type of fact patterns, we can support you in the experience. Take a look and see whether Roth conversion makes sense, because again, depending on your fact pattern, that can be an interesting saving strategy. Don't forget about HSAs. One of the things that may not be obvious yet if you haven't enrolled in Medicare, but is that Medicare costs a lot. The average member, if they're buying a fully loaded plan that includes, for example, a Medicare supplement plan, probably spending over $500 a month on their Medicare plan. You wouldn't think that when you watch the commercials on TV late night right now, which are quoting lots of zero premium plans. But the reality is that a zero premium plan does not mean zero cost. And so the HSA can be really helpful to pay for out-of-pocket costs, for coinsurance, for deductibles. And the last thing I would say is that, particularly as we get close to winter, I'm based in New York and we have our first snowfall today. Some of you may be thinking about becoming snowbirds. And so one thing I would just encourage you to really think about is just understanding, like, whether you're moving somewhere full-time or you're just thinking about being a snowbird and having a second place that you live, really understand the consequences of those decisions. And so one of our actually most popular calculators in our experience is our cost of living calculator. And you can actually calculate your retirement score today in Michigan. And then if you're thinking about being a snowbird in Florida or a snowbird in Arizona, you can see what the impact is on your retirement score and see whether actually your savings last longer in those locations, or it actually makes sense to be tax domiciled in Michigan. And so just take a look at that. And I think that'll be super interesting so that you can really understand not only the kind of the taxes, but healthcare costs and general spending, because there's a lot of factors that go into, how long your savings last in retirement. So we went through a lot of numbers for 2023 today. I'd say the good and the bad news is the numbers are going to change again next year. And the good news is that many of those numbers will be in your favor, meaning that they're inflation adjustments. The bad news is it's something else to keep track of. And so that, again, is where at Retirement Simplified, we can help you stay on top of those numbers and make sure that as the numbers are changing, we'll send you an email and say, look, by the way, here are the new numbers. Here's the deadline. Really make sure that you get what's due to you. Lots of other topics that we cover in Retirement Simplified, and I'm going to go to questions in 1 second, but just want to flag that probably one of our most popular classes is a class we have on the taxation of Social Security. That I can tell you frustrates a lot of soon-to-be retirees and early retirees when they realize that part of your Social Security is taxed. So the class covers how it's taxed, also covers what states also tax it. So it's taxed federally, and then what states tax it. We have a lot of information about how where you live impacts your taxes. And then we have, in addition to all this tax information, I'd say our other set of most popular classes are our classes on Social Security. So we have classes, whether you're single, married, divorced, widowed, we have classes for every single fact pattern. We have classes on part-time income and how that impacts Social Security. So kind of everything is covered in that class. All right, so I've been talking for a while. I wanted to make sure I saved 15 minutes for Q&A. So let's open up Q&A and let's dive in. All right, so does Silvur sell share one's personal information with other businesses? So no, we do not sell the information to third parties. This is a partnership between Silvur and Michigan State. So Michigan State University Federal Credit Union has access to the data alongside us so that we can provide you these tools and calculators and really guide you through retirement, but we do not sell them to any third parties. And so really what I would just say to you is that it should be very obvious to you in the experience why we're asking questions. We are asking you questions, for example, about what your income is, so we can calculate your Social Security. We are asking you questions about how much you've saved for retirement, so we can calculate your retirement score. We ask you questions about your zip code so that we can estimate your Medicare costs for you, because the cost of Medicare actually depends on where you live. So we are really asking the questions that are important to help answer the questions that we think you have, and also provide you with clarity, because if you don't put your numbers in, it's really hard for us to actually give you these calculations. All right, so second question is, I thought you need earned income to contribute to a Roth, and that is correct. And so I don't know if I missed that, but you definitely need to have income to be contributing to a Roth account. I see another question, which is, if I'm paying a sizable upcharge for the IRMA, how easy is it to lower it now that I have no salary? Okay, so Joseph, that is a really good question. So if you, I think we probably have your email address, but if you want to just send us your email address in the chat where just Lindsay and I can see it, we're gonna send you the document that you can file to basically ask the IRS and Medicare to adjust your surcharge. Because oftentimes what happens is, like, you had, let's just say you were working 2 years ago and you had an income that triggered IRMA, but you're now not working. That may be a fact pattern where you're able to go back and say, well, look, that data is old. Like, it's kind of ironic that in this day and age that the government is running all these numbers based on data that's 2 years old. And so they kind of acknowledge it by saying, yes, we're using old data. And so if the old data is not correct, then you can give us the new data and we will cancel your surcharge. I am not remembering at this very moment in time the name of the document, the code number, but what we will do, Joseph, is we'll send you that document after this call so that you can fill it out. It's actually not that complicated. The key thing is that they define what the qualifications are for having the IRMA canceled. One of them is a change in income. So it's actually, I would say, very common in your first couple years of being on Medicare, that if that aligns with when you stopped working, that you could actually get the IRMA surcharge rebated. The other thing I would say, Joseph, and you probably know this, is that on the statement that you'll get from Social Security, when they show you your benefit and they net out Medicare, they also show you whether you're being charged the IRMA surcharge. So that actually is how, for folks who are not sure, if you're receiving if you're being charged the IRMA surcharge, the way that you find that out is you actually look at that statement, and that statement, because it shows you how much Social Security you're getting, and it shows you the cost of Medicare. If you're being charged the IRMA surcharge, it will be on that statement. All right. From Thomas, what happens to Medicare and Social Security if the government shuts down? Okay, so this is, I feel like the government puts us through this rigmarole every single year, right? We go into year end and everyone is really worried. I guess a couple of things I would just say is, the first thing is that to date, I am not aware of Social Security payments not being made. When the government shuts down, typically there are like carve outs for, like, let's call it essential spends. And so historically, when we've had these windows of like 90 days that the government is shut down, and I'm thinking that was probably was it 2018 or 2019 that last kind of officially happened, the Social Security paychecks are still paid. I think policymakers know that it would be really bad for voters, for just the health of the economy, to stop paying those Social Security benefits. And then again, remember, Medicare is deducted, and so kind of the net of that is it is netted out. Now, I thought maybe where you might be going, Thomas, was also asking about like the viability of Social Security long term, and I would just say that just kind of the quick takeaway there is that there's going to be a lot of discussion this election cycle about how to make Social Security more resilient for the long term. I would say I'm party agnostic in this conversation, which is it needs to be viable long term. Folks like all of us on this call, you, me, are paying taxes into the system, and we need to be confident that we're going to be able to get our retirement benefits. This is a forced savings program, and we want to make sure that the money we put in, that we're going to get our benefits back. I believe that there will be changes that are made, and there's obviously different proposals from the Democrats versus Republicans on how to make it solvent long term, but we need to make it solvent. And so I think we're going to hear a lot more about solvency. Again, I think it's very bad policy for folks to not believe that it's solvent, and then also for it not to become solvent. And I cannot imagine a world where the government just lets Social Security fall apart. Again, there's always these like 1% chances, but I believe that both parties are committed to making it solvent. They just have different ways they want the math to work. And the question is, which set of math is the final math that kind of comes to be. All right. We have a question about services available from Silvur and costs. So the first thing is that Silvur is a free member benefit. So MSUFCU actually pays for Silvur for all of its members over the age of 50. And so there is not an additional cost. It's really there. I think you all know that Michigan State University Federal Credit Union is deeply committed to financial wellness and making sure that you all feel like you're getting the education you need to make key financial decisions, and retirement is one of the biggest sets of retirement decisions you're going to be making. So you create your profile, you're not being charged. Michigan State, it really takes care of this for you as, I think, an awesome perk for being a member of the credit union. All right, so Mary, I'm just going to read your question out loud if folks don't mind, and I'll make sure that we see. So it says, despite my age, my deceased husband as of August was 81, so he was already automatically getting a percentage of his 401k withdrawn. So I think that's the RMD. Once he died, his 401k became mine, but I was advised that the withdrawal is still mandatory. Does that mean now my 401k, formerly his, and what I have in my account? So Mary, yes, you are subject to taking RMDs from a spousal account. What I just want to check is a couple things. And so thank you for actually adding your email address in, because this is one where I do want to do a little bit of follow-up. Is there are some rules that are specific to spouses that have age differences. And I just can't remember off the top of my head whether the age difference is 10 years or 20 years. And so I want to just check with you there, because there's actually a different RMD schedule if spouses' ages are kind of at a certain threshold. Typically, again, like what I want to just also triple check is that for the inherited account, like I believe it runs off of your age, not his age, but that's what I want to just triple check for you. So let me, Mary, come back to you just with a little bit more detail. But the account generally is subject to RMDs. What I just want to triple check is, because he already started his RMDs, what that means for you. And then also, are you at all impacted by this kind of age difference, which is a different RMD table that we'd be looking at. So I'm going to come back to you, Mary, just so I make sure I get the right answer there. All right, so Roth conversion question, how do I do if I'm retired and therefore don't have any earned income? And so Kathy, this is one where the financial advisor team at MSUFCU can walk you through it. But the point here is a Roth conversion doesn't require you to put more money into the Roth. It's just you're taking an IRA or a 401k and you're converting it into a Roth. So it's not about contributing, it's about converting the account you already have. So what they can work with you on is figuring out, is there a specific account that makes sense to do a conversion on? All right, Sarah, also another question about Roth conversions. if you're retired, receive Social Security and a pension, but work very little, so earn less than $1,000 a year, can you convert a 401k to a Roth? So what's interesting here is that the 401k, the conversion to a Roth does not have income limitations. So typically a Roth account does have income limitations. So when you initially fund a Roth, there are income limitations, but the conversion of a 401k to a Roth is actually a loophole. It's not subject to those same income limitations. So again, Sarah, this is where I think the wealth management team can kind of go through, look at your fact pattern, figure out if there's an account that makes sense, helps think about like what your taxes look like today. Because I think the big thing to think about as you're thinking about Roth conversions is it worth paying taxes today versus paying taxes in the future? And that is really based on what your income profile looks like, what how much you think your tax rate's going to look like in the future. And the team will be able to do some of those calculations with you to help you figure out, does that Roth conversion make sense? Because oftentimes it makes more sense to defer taxes, right? Not to pay them until later in time. And so that's where it's, again, just the specifics of your fact pattern. They can run through that with you. All right, so we have a lot of questions. So first of all, I just wanted to say thank you for all those questions. Lindsay, I closed the poll so that let me just see if I can see it again. Okay. So that I could see the screen, but I don't think I can see the results. So maybe, do you see the results and can you read them for us? And then we'll chat about those results quickly before wrapping up.
Absolutely. Yeah. So it looks like when we were asked, are you already working with someone on retirement planning? Looks like a healthy number, 55% of our callers are actually working with someone. So that is fabulous. But we have another like 34% who aren't currently, and about 14% are very interested in working with someone, but haven't started to yet. So
okay.
Pretty good information there.
So
So glad all of you could join us.
Yeah, I was going to say, yeah. So on that one, Lindsay, what I would say is, first of all, kudos to those that are doing planning. I think like retirement is complicated, and you don't need to have a huge net worth to qualify for planning. Like everyone should be doing planning. And I think sometimes we think that planning is only for people that have saved a lot of money. And I'd say that the reality is that planning is for everyone. There are different paths. You can work with an advisor. You can go online to Retirement Simplified and do some of your planning through this experience. For those of you that are looking for some guidance, again, that's where Lindsay's team, I'm sure, would be happy to follow up and see if they can be helpful for you on this journey.
Absolutely. And then we have, when it comes to which best describes your tax interests, it looks like we have 10% of people are looking for help with a specific problem or challenge. 66% feel pretty good about taxes, but they're looking for some of those tips and tricks. So again, so glad y'all could join the call today. Hopefully Marianne was able to share, and I know she shared quite a few with us today. So hopefully that helps you along your journey. And then 24% of us say that we need a lot of help. So I'm just going to go ahead and like pass it over back to Rianne to say like, hey, if you're looking for that extra help, definitely check out Retirement Simplified. They've got like really quick, great reads where you can inform yourself. And we're happy to support you in that journey. If you go to msufcu.silvur.com, that's where you can find a lot of that information on how to get started.
Great. And then I think the last one was how many folks online today have already created their Retirement Simplified profile?
Yeah, so we have about 14% are currently using Retirement Simplified. So yes, absolutely. Kudos to you all for getting started and already getting access to this wonderful information. And about, the other 79% plus are not currently using it. But some people are looking to use that too. So definitely look into how Retirement Simplified can help you along your journey. Again, this is a free service offered by MSU Federal Credit Union. So we're happy to support you in that way. And then additionally, we obviously have our fabulous team, our financial solutions team, who has advisors willing to help you along your journey. So You can reach out to us by calling 517-333-2424 and dial us at extension 7180 to schedule a complimentary, no obligation appointment to kind of talk through what your needs are, what you might be looking for. And then from there, an advisor can kind of decide like, what exactly do we need to talk about, and go through like further costs and things like that, to really help you along your journey there. But
so Lindsay, I know that
yeah.
I had trouble getting that number down fast enough. Do you
Yes,
mind dropping
sorry.
that number into the chat? Because I
Yes,
think
absolutely.
the number that you know, but just so that everyone has a minute or two to be able to capture
100%.
it.
Yeah.
And I think that I actually saw one last question come in. So we're going to put the URL in also, and then I'll just put it right in here. Actually, maybe Lindsay, if you can just put the MSUFCU silvur.silvur.com in so that everyone has that. The other question I saw come in was the costs associated for advisors. And that's, I don't know, Lindsay, that you probably know that off the top of your head, but I would just say is my experience with financial advisors is that they are typically charging, a percentage fee based on the assets that they're managing. And through that free financial review that the team will do with you, they would, I'm sure, be very happy to answer that question with you.
100%, Rianne. Yeah, that's kind of more what that looks like. But again, there's just that initial consultation, which is free, no obligation. So again, we invite you to reach out. And again, I know I talk fast. I apologize, but that number is 517-333-2424 at extension 7180. And friends, we want to let you know too, Silvur will be joining us again in 2024 to bring 2 additional webinars to us. So please check out, you can go to msufcu.org/events to learn more about those webinars that will be taking place. But on Tuesday, April 9th, we'll be discussing from 12 to 1 p.m. during that lunch hour again, how women specifically can maximize their Social Security retirement benefit. And then again on Wednesday, April 24th, we'll have an evening session starting at 6 p.m. where you can do a little bit deeper dive into Retirement Simplified to really learn how that can help support you along your retirement journey. So definitely check those events out. Feel free to register. If you have questions in the meantime, we'll be happy to answer those for you. But again, I just want to say thank you so much, Rianne, to you and your team at Silvur for joining us today. This has been absolutely fabulous and so informational. We really appreciate all that you do to help support our members and our community by offering your services and your webinars to us so that we can really expand our literacy in some of these sometimes very hard to understand topics. So thank you for everything. We appreciate
you're very welcome. And I just wanted to say thank you to the members on the phone, because being actively engaged is the best way to make sure that you can live your retirement in the way you want to and retire fearlessly. Our hope is just to be able to empower you along that journey. So thank you for being part of this journey, because you control your destiny, and our goal is to provide you the information that'll help you be successful. Thank you very much.
Well, thank you, everyone. We hope you have a wonderful rest of your day, and we hope to see you at some of our future financial education seminar series events. But have a good one. We'll see you soon.
Thank you.
Thank you.